folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 74.94. That's up about 9.3% year to date. I thought we'd go around the horn and do a little bit of, where all the various indices are. Small caps having a great year. The Russell 2000 up about 19% year to date, so about a 10% ahead of the S&P 500. International stocks kind of keeping slightly ahead of the S&P 500, so those are up about 10.5% year to date, so about a 1% ahead of the S&P. That's largely driven by some really strong performance in emerging markets for the course of the year. And then if you look at the Magnificent Seven, we're going to talk a little bit about some sector rotations that have been going on. So if you look at the Magnificent Seven, they've actually trailed pretty significantly. So all of those stocks that Jim Cramer loves to, pump, those are up about 1.6% year to date, meaningfully trailing the rest of the market. Meanwhile, the semiconductor index is just having a monster year. It's up close to 70% for the course of the year, but we are seeing some rotation out of that. So over the past 2-ish weeks, that semiconductor index is down about 18%, while at the same time, the S&P 500 is essentially flat. And if you've been following the market narrative over the course of the past couple of weeks, that's been the single largest narrative, is this rotation out of some of the high-flying AI names, semiconductor stocks that have worked very, very well, and rotation into more traditional holdings, so which is normally a healthy thing for the market. We call that consolidation within the market. Generally means that the market is sort of getting comfortable with its new level. We'll see whether or not that peters out or not, but for the time being, it is certainly okay in our book if we see some of the high-flying stocks give up a little bit of their gains when those gains are then reinvested in other areas of the market. So that's good. I'd also just note, because I can't help myself, that SpaceX is trading currently at about $150 a share, which is the same price that it opened at on the day that it opened. So just so we're all clear, hasn't really moved since the open. Actually, it traded up and then has traded off significantly to the point where it's now just flat to the open. Couple of narratives that are out there other than this consolidation story. Probably the single biggest one is on unemployment. So last week we got an unemployment reading that was a little bit weaker than everybody was looking for in terms of job creation. Added about 57,000 jobs in June. And then the job creation numbers for April and May were both revised downwards to the tune of about 40 to 30,000 jobs, respectively. And I will just say that one of the things that I think was very strong coming into June was how large the job creation numbers were. And now we're getting a little bit of a sense that maybe those numbers were just a bit of a fluke in measurement. We're averaging now about 75,000 jobs created a month, whereas about a month ago we thought that number was more like 150 to 200,000 jobs a month. And that is, in a weird way, actually good for the Fed. When we see inflation potentially being a problem and we see job creation numbers that seem to be kind of running away from us, I think a lot of people, if you'll recall our video from about 4 weeks ago, the market interpreted that as a negative. Good news is bad news, right? We're creating too many jobs. That means the economy is too strong. That means we actually need to, throw some cold water on this fire by potentially raising rates. I think in this case, the market generally looking at the job creation numbers that came out last week and saying, okay, so the economy's growing, but it's not quite growing at the pace that I would really like it to. And that's going to continue to keep the Fed on hold, at least for the foreseeable future with respect to interest rates. It means that they don't feel the need necessarily to raise rates going forward. We'll have to see the next time the Fed meets whether they update the dot plot, but certainly all of the hawkish rhetoric that we got out of the Fed in the last Fed meeting would now be revisited with a lens of employment not quite growing as fast, which I think the market would generally view as a positive. With that, as always, I hope you're having a fantastic day. If you have any questions, please feel free to reach out to myself or to your advisor. Enjoy the summer, and we will come back to you again soon.